Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review gold and silver specifically, talk about how high can it go, and when can we spot a potential pullback. So let's go ahead and review this information and of course review the charts. First, let's go ahead and observe the dollar index. It is chopping sideways a bit. It hasn't been able to break that previous area at around 75.062. So again, that's somewhat of a short-term resistance area on this chart. But pretty much, dollar index has continued its downward trend. And the only way you'll ever see silver and gold have a sizable pullback is when the dollar index has a sizable gain, and that's going to take some time. But recently, the Federal Reserve has been starting to change their whole entire dialogue. Basically, the FOMC meeting, which is I think it's the Federal Open Market Committee. I'm not exactly sure, but basically, it's the committee that overlooks the permanent open market operations. And basically, what POMO, or permanent open market operations, is that these guys, or the central bank of the United States, which is the Federal Reserve, they go out and they buy a ridiculous amount of short-term treasuries along with long-term treasuries as well. And basically, the whole idea is to inflate the economy with easy money. Now, the thing is that once the Federal Reserve, and if the Federal Reserve decides to stop doing this permanent open market operation earlier than the anticipated June or May or June, somewhere in that area where people anticipate them to stop, that's going to have a direct impact on the US dollar. A lot of people are trying to diversify out of the US dollar into other currencies, but that could swiftly change once we get a rate hike, something that will stem inflation in the United States, or at least keep the dollar index from continuing to go lower. And there's many reasons for why the dollar index continues going lower. One of them being the fact that a lot of people, well, not really a lot of people, but a lot of central banks, what they decide to do, especially out of China and the Middle East, is that they go ahead and they like to, in the case of the Middle East, they sell their crude oil, they earn their money with dollars. I mean, it's not that the dollar isn't the reserve currency anymore. It's just that people want to diversify out of it because they have so many dollars. I mean, look at China. What China does is that they take their Chinese yuan, they convert it over to the US dollar in massive amounts, therefore making the US dollar artificially more powerful, or supposedly more strong, leaving, in our case, leaving the Chinese yuan relatively weaker. So when we buy those Chinese exports, or for them it's exports, it's for us we're importing in those goods from China, it's relatively cheaper. Now because of that, China is left with a ridiculous amount of US dollars every single time they manipulate that currency. What they're left with is a humongous pile of US dollars. And what you see is a long upward trend in the euro-US dollar. If I was sitting on trillions and trillions upon US dollar after currency manipulation, what would I do? Well, I would take my US dollars and I would just pump them into the euro. Now, if you guys look at the euro-US dollar pair on a long-term chart, you guys will notice that the euro-US dollar has been going up ever since the 1.29 area back in 2011, and even further down at the 1.20 area back in 2010. And that's basically because of central banks diversifying out of the US dollar into a currency that has shown to perform against the US dollar. And the sovereign banks, or the sovereign wealth funds, and the Chinese central bank gets to make added, there's appreciation that comes from it, but on top of that, it hedges their inflation risk as well. What that basically does, going back to our original point with gold and silver, that makes the US dollar index depreciate that much faster, therefore making the gold and silver market appreciate that much faster. So again, the reason why the US dollar is losing so much ground and so much value is basically because of Chinese currency manipulation along with Middle East currency manipulation as well. The European central banks would prefer, and I mean this quite literally, they would prefer having their euro much weaker to the US dollar, therefore making European exports much more competitive. But against a roaring giant from the east, and not so farther than them, the Middle East, constantly diversifying out of a dollar into a euro, there's nothing the European Central Bank can do to keep their euro from basically appreciating out of control. So that's the whole issue on the global scene. Now, as far as gold and silver, I think that a great short-term target would be somewhere around $50 per ounce on silver. As far as gold, I'm willing to be relatively conservative and think somewhere around the $1,500 to $1,600 area. Now, the main reason why I'm not as bullish as all these other silver pundits out there is because of the fact that the central bank may plan on ending their permanent open market operations. Now, this goes back to our original point. Why is permanent open market operations so important? Is because it floods the market with easy money. What do foreign countries do with excessive amounts of easy money as far as US dollars are concerned? They like to dump it for euros, therefore making the dollar index weak, therefore making gold and silver continue to go higher. When gold and silver eventually pulls back, though, which it will, once that permanent open market operation occurs, you're going to see a pretty sizable pullback from maybe the $50 area for silver, and as far as gold is concerned, it's probably going to pull back from its highs at around 1600 to anywhere from 1500 to 1600. You're probably going to see a sizable 10 to 20% correction. But historically speaking, even if the Federal Reserve does do rate hikes, it really doesn't, it won't have that bad of an impact. Because you guys have seen, ever since 2003, even with each subsequent rate hike, you might see a pullback and then it continues going higher. And the point is that you're going to see a pretty sizable pullback, and then you're going to see silver and gold continue to go higher because people are going to assume, okay, Federal Reserve no longer does permanent open market operations, assuming that growth is coming back. And remember, without the Federal Reserve borrowing money in the bond market, or basically lending money in the bond market and buying out all these bonds, pushing these investors out of bonds into the stock market, and also inflating the economy with easy money, what you're going to eventually see is the interest rates go higher. People are going to have to lend more money at a percentage rate higher than the percentage interest. That's the only way money actually increases in this Keynesian economic theory thesis, and that's basically how this economy is designed. But basically, in Keynesian economics, what you need to do is have interest rates. If you have a 5% interest rate, you would need to lend 5% more every single year to increase the, you'd have to lend more than 5% every subsequent year. So you have to increase the amount of lending you do by 5% for every single year to increase the monetary supply. And that's where the whole issue is coming. People aren't able to borrow money, or people are uncreditworthy of borrowing money to buy homes. But right now, the Federal Reserve is flooding in the markets with money, and hopefully that money is lent out somewhere. That's the hope here, guys. And if it doesn't work, you're going to see the Federal Reserve come back and either they're going to do a quantitative easing 3, flood the economy with more dollars, or they're going to loosen the lending standards again. And if you see a loosening in lending standards where people can borrow money easily, you're just going to see a rewind back to 2000 through 2007. So we're left with very few options here to grow an economy, and it's basically a hope scenario. I hope that this works out, because if it doesn't, we're going to have to go back and do what we did back in 2000, create another bubble and have it crash, or we're just going to have to sit with a deflating economy for an extended period of time. So there aren't that many options here. The point is that, again, if you guys see the gross domestic product grow at a tremendous rate, that means, and you guys see a lot more mortgages going out, and you see the economy inflating again, which is the hope, then you're going to see gold and silver continue to go higher. Another thing is that gold and silver is seen as a very, very safe investment. So again, you keep that mentality that this investment is safe. You're probably going to see a pretty decent pullback in gold and silver once the Federal Reserve starts raising their interest rates again. But eventually people will come back to gold and silver after you see a sizable pullback. And eventually I think silver could actually reach $140 per ounce As for gold, I'm not too sure on it. I could probably see $2,000 per ounce, maybe 3 years from now or something like that. As for silver, $140 per ounce, somewhere 3 to 5 years down the road as well. Again, I'm not anticipating $140 per ounce or $100 per ounce by the end of this year. It's probably not going to happen, mainly because the Federal Reserve will start raising interest rates again. Permanent open market operations will come to a close. A lot of the stimulants that caused gold and silver to go up won't be there, so you're going to see a minor pullback or a pretty major pullback, and then you'll see gold and silver resume their long-term super cycle, long-term trend, and preferably or most likely it's going to be a long-term uptrend. Anyway, that does it for me for today. I hope that information helps you guys all out, and if you guys are into this kind of stuff, be sure to subscribe to this YouTube channel. And also, if you guys want to use the same charting software I use, just check out the link right below this video. And that pretty much does it for me for today. Take care, guys, and I'll have more for you in the coming weeks and months ahead.